Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Guys, in today's class we'll be practicing on SBR's ethics part as well, right? So ethics is all about remembering what does the code of ethics tell you. There are certain principles, there is a code. Code means a practice, a conduct which you need to follow. So all accountants need to make sure that they maintain their integrity, objectivity, professional competence and due care. You need to make sure of your professional behavior, and you need to maintain confidentiality of the knowledge that you have obtained while working on a client or a company, right? So right now we are going to discuss on a past paper. This is basically a specimen exam which was published by ACCA some time back. To give you a brief glimpse of how the requirement looks like, this is a complete ethics question which you can call. Remember, you guys all know that whenever you get a question on ethics, which is generally your question number 2 of your exam, it is of 20 marks, and most of those 20 marks will comprise of accounting areas and ethical areas. So you get a mixture of two things in one question. There you get a certain amount of marks whereby you only discuss regarding accounting implications, and from those accounting implications and with reference to the scenario which has been provided to you by the examiner, you discussed what are the ethical implications in that particular scenario. More commonly, you will always get 2 marks, 2 professional marks on your exam in this ethics question. So in SBR paper currently, there are total 4 professional marks, and these professional marks are awarded to you just for your just for your clarity of answers and the conceptual knowledge that you have and how you construct your answer. So these are 4 professional marks. 2 marks will be given in section A, 2 marks will be awarded in section B. From section A, the 2 professional marks are always in question number 2. So whenever you get question number 2, it will comprise of accounting implications and ethical implications both, and 2 marks will be for 2 marks will be for professionalism. All right. So overall, this is a 20-mark question that you're watching. Examiner's requirement is that you need to discuss the ethical and accounting implications of the above situation from the perspective of the reporting accountant. So examiner wants you to take a clear guideline. Examiner wants you to take a clear position in this particular question. He wants you to take the position of the reporting accountant, which is the subject in this particular case scenario. He wants you to take the position of a reporting accountant and discuss what are the accounting implications, how the accounting should be properly performed, and wherever you see any accounting, any ethical areas in this scenario, you need to discuss the same. All right. So let's go through the entire question. Let's discuss and then we'll go towards the answer. All right. So examiner says AB. AB is a company which conducts business in several parts of the world. So your presence is not only in one country, you operate in multiple countries. So you might have some, foreign transactions as well. This is what you see. Whenever I do a practice past paper with you guys, I always try to think like a student. So if I were you in an examination and I saw this word that AB operates in different parts of the world, something that would come into my mind is that maybe you're operating under a different model in each of the countries, or maybe there are some foreign currency transactions associated in such a scenario, or I would refer to IAS 21 and different sort of things. So these type of things would come into my mind. All right. So how examiner has given this question to you is, examiner has created certain paragraphs, and each of these 3 paragraphs are given a certain heading. So it's very clear what are the accounting implications that you need to discuss. So you need to discuss about related party transactions. The other paragraph is going to be about subsidiary fair value adjustments, and the third paragraph is going to be about goodwill impairment calculation. So all these 3 areas are before you. As far as you talk about related party transactions, examiner tells you the accountant has discovered that the finance director of AB has purchased goods from a company RY. So basically, you are the accountant, and you have just discovered that the finance director of AB company, your boss, literally your boss, the top layer person in your organization. So you have just discovered that the finance director has made sure that some goods are bought from a particular company in this scenario whose name is R White, which, and you came to know that which the director jointly owns with his wife, and the accountant believes that this purchase should be disclosed. Which accounting standard are we referring to here? What do you think? Which accounting standard is being implied here? Obviously, when you saw this heading, it would have come into your mind that IAS 24 is the subject accounting standard. Yeah. So according to IAS 24, the objective of IAS 24 is to draw attention to the fact that there is a possibility that transactions between related party happen, and they happen on a non-arm's length basis. Now you need to remember that according to IAS 24, if a transaction with related party happens, and a related party can be an individual or another company, IAS 24 reminds you that even if a transaction with related party happens and that transaction is on fair basis or fair value basis or is even on arm's length basis, then even the transaction should be disclosed. You see, IAS 24 is not stopping a company from transacting with related parties. If you're doing business, you need to transact with related parties. I mean, nobody is stopping you. But as IAS 24 wants that such type of transactions should be disclosed separately under a disclosure, because there is always a risk that whenever you do transactions with your related parties, those may be done on a non-arm's length basis. And if they are done on a non-arm's length basis, your investors, your shareholders have a right to know about. All right. They may already know about them, but still a potential acquirer of your company, or maybe a tax regulator, or maybe other external stakeholders should have the right to know about such transactions, and therefore these transactions need to be disclosed. So we studied under IAS 24 that a related party can be a person or can be an entity. A related party can be a person who controls or jointly controls your entity, a person who has significant influence over the entity or is a key management personnel. And then there were entities who can be classified as related party as well. I'm just giving you a recap of IAS 24. So many a times many people say, sir, why don't you take a revision class of all accounting standards? You see my lectures for questions. Whenever we do any question, I make sure that I give you a recap of the entire standard which is in the subject question. And likewise, when we do many questions, you get a recap of all accounting standards that you have studied, right? So an entity can also be a related party. An entity which is which the reporting entity controls or jointly controls, or is under significant influence, or is a group company, or is owned by a person who is identified as a related party. An entity which is controlled or jointly controlled by a person who is classified as a related party is also supposed to be a related party entity. Make sense? And then we saw multiple details under IAS 24. Yeah, so we had a very good overview of what IAS 24 said. So right now it's apparent that the finance director is definitely a key management personnel, and he jointly owns with his wife another entity from which you guys are purchasing goods. So let me clarify it to you. You are AB. You are purchasing goods from a company. AB has a finance director, and this finance director along with his wife jointly controls this particular second entity as well. So a company which is controlled or jointly controlled by your key management personnel, by a person who is already classified as a related party, this makes this particular entity a related party as well. And according to IAS 24, such a transaction should be disclosed, right? So accountant wants to disclose this transaction. The accountant believes that this purchase should be disclosed. All right. Then examiner says, however. Now, whenever you see the word however is always used for something which happens in opposite. So accountant wants to provide a related party disclosure, then there comes the word however. However means that there is a position which is opposite to the disclosure requirement. Yeah. So there is another opinion about it. So however, the director is refusing to disclose the transaction as in his opinion. So he is trying to justify his position, by providing his opinion. You see, whenever you prepare financial statements, you need to make sure that you apply IS and IFRS in its entirety. There can be no opinion and cherry picking about applying a particular accounting standard. There is no opinion of an accountant, right? So all accountants have to make sure that they maintain integrity and objectivity, and they should not allow any of their personal interest to override their professional judgments. But what your finance director is saying, the director refuses to disclose the transaction as in his opinion it is an arm's length transaction. So your director is basically saying we should not be disclosing this transaction because it is already on arm's length. So since it is already on arm's length, why are we disclosing it? Your director has some professional competence issues, because he is not clear, he is not sure about what the standard actually says. Now, if he's a finance director, he should be competent enough. To make sure he knows what IAS 24 actually requires. Now, IAS 24 clearly says that even if the transaction with the related party happens on an arm's length basis, happens on a fair value basis, happens on a market practice basis, even then such type of transactions must be disclosed. Examiner says he feels that if the transaction is disclosed, it will be harmful to the business, and feels that the information asymmetry means lack of something. Yeah. So your finance director is saying that the information asymmetry caused by such non-disclosure is irrelevant because most entities undertake related party transactions without disclosing them. So let me recall this whole scenario. You are an accountant. Believe yourself as a reporting accountant. You have just witnessed that your company is purchasing goods from a company which is jointly controlled by your finance director and his wife. Yeah. So you want to disclose this transaction as a related party transaction. But your finance director is of the opinion that such transaction should not be disclosed. Why it should not be disclosed? He understands that this is a related party transaction, but he says, okay, I understand this is a related party transaction, but it is already on market value basis, and therefore we should not be disclosing it. And plus, he is of the opinion that if we disclose that a transaction is being happened with a company which is controlled or jointly controlled by the key management personnel of the entity, it will give a bad opinion of the company in the market. And according to him, we should not be disclosing this transaction because everybody in the market is doing such type of transactions and nobody is disclosing them. So if nobody is following IAS 24, why should we follow it? He is of this opinion. I'm sure this is against professional behavior because he is asking you to do something which could discredit the entire profession. I mean, if everybody is doing something wrong, that does not mean that you should be doing the same thing. You should be doing the same wrong thing. It will not make you right. Make sense? Examiner says, similarly, the director feels something, that competitive harm would occur if disclosure of operating segment profit or loss was made. Oh. Now here comes IFRS 8 in between. You remember IFRS 8? Yeah. So according to IFRS 8, an operating segment is basically a component of an entity, yeah, which has its separate results. Its performance is monitored by the chief operating decision maker, and it has discrete financial information available. And if a company has some operating segments for which the financials are reviewed by the chief operating decision maker, it's a component of an entity and its discrete financial information is available, a disclosure of operating segment must be provided. So you need to clearly tell your shareholders how you are earning the money from A business, how much you are earning and how much profit or loss you are making. From B business, how much profit you are or loss you are making. From C business, how much profit or loss you are making. This type of information will help your investors in making their financial decisions on a more informed basis. But your finance director, who feels himself as if he is a very good finance director, is saying that we should not be providing this disclosure of operating segment for the purpose of profit or loss, because if we provide such a detailed disclosure, it will give us competitive harm. In what sense it will provide us competitive harm? Our competitors will know which of our products is loss making, which of our divisions is profit making, how well or how poor are we performing in terms of our operating segments. And therefore, since competitor will get to know about our information, we should not be providing this information. Absolutely wrong perception. You see, you need to make this clear in your mind that the accounting principles are such that even if they provide a certain bit of competitive harm, even if it provides your competitor information, detailed information about the company, but if that information is relevant and it can be faithfully presented in your financial statement, then that information must be provided. That information must be provided to your shareholders, even if it comes at a cost of competitive harm. You cannot decide not to disclose a particular sort of information just because you feel, although it's relevant for your shareholders, it's relevant for your investors, but you decide, oh no, my competitors will know about me. You cannot just cherry pick and say, I'm not going to apply this accounting standard. Here again, there is an issue with the objectivity of your finance director. He is not being he is allowing his personal interest or maybe professional interest. He's compromising on his integrity and objectivity. Yeah. As a result, the entity only discussed a measure of total assets and total liabilities for each reportable segment. This is wrong. Yeah. So you're not supposed to only provide a disclosure of total assets or total liabilities for each reportable segment. You need to provide a sufficient amount of breakup of your P&L and your balance sheet so that investors can understand how the business is being run. I mean, they are the ones who are basically putting money into the business, and they have the right to understand how the business is actually being run. And whatever capital they have provided you, how much capital resource allocation you are doing in each of the segments, and how much return you are earning on them. So just by providing total assets or total liabilities, it does not serve the purpose. I mean, proper classification for current and non-current should be provided. Proper classification for profit or loss breakup should be provided, right? Okay, there can be some common costs such as administrative expenses or something which cannot be bifurcated in each of the different business segments. But as far as sales is concerned, cost of sales or gross profit is concerned, at least this level of information should be provided for your P&L for all reportable segments, even if it provides you a certain risk of competitive harm. So technically, finance director is wrong here. Examiner says when preparing the financial statements for the recent year ended, the accountant noticed that R White is the same company from which you were acquiring goods, which was a related party according to us, according to the reporting accountant, right? So examiner says the accountant noticed that R White has not paid an invoice for several $1 million, and it is significantly overdue for payment. So the company which is owned or jointly owned by the finance director, they have to pay some money to Abby too. They have to pay some money to Abby as a receivable from a related party entity who is jointly controlled by your finance director and his wife, and they have still not paid this money. They have still not paid this money. It is significantly overdue for payment. Now, if an invoice, if a receivable is significantly overdue for payment, you should be recognizing a credit loss against it, right? You should be recognizing impairment against it, expected credit losses and actual perceived losses. Yeah. It says that it appears that the entity has a liquidity problems and it is unlikely that Arvite will pay. So maybe a bad debt should be recognized, or actual expected losses should be recognized. Lifetime credit losses should be recognized. It says the accountant believes that a loss allowance for trade receivables is required. So accountant is clear. The accountant wants to report a loss allowance on trade receivables. The finance director, again, he comes into play. The finance director has refused to make such an allowance and has told the accountant that the issue must not be discussed with anyone within the trade because of possible repercussions for the credit worthiness of Arvite. Look at the attitude of your finance director. Your finance director is saying, you see, your finance director is telling you, do not discuss this issue with anyone. Neither recognize a loss allowance in your books, nor discuss this anyone within the trade. Because if you discuss this within the trade and people get to know that Arvite is not able to pay its for its obligations, then there might be some negative reputation or liquidity issues or credit worthiness issues for Arvite. Your finance director is still not concerned about Abby. Yeah. He is still concerned about the credit worthiness of Arvite. Now, what should your accountant be doing? Should your accountant be saying, okay, sir, as you say, you are my finance director, you are my boss, whatever you say, I am going to follow? No. The reporting accountant should maintain his or her integrity. Yeah. So he should make sure that he remains straightforward and honest in all his business and professional relationships. And therefore, he should tell the finance director, you see, if you do this, this is not in accordance with IFRS. Now, IFRS wants you to apply all accounting standard in its entirety, and you cannot cherry pick to apply a particular accounting standard and not to apply a particular accounting standard. And any information which is relevant and can be faithfully represented to your shareholders, that information should be provided. That information should be provided to the shareholders. Your finance director is also trying to he is also trying to force you into something. He is saying you must not discuss with anyone. Now, you should not allow, the reporting accountant should not allow the undue influence being exercised by the finance director to override his professional judgment. The reporting accountant cannot say, okay, I am going to follow your whatever you are saying. I'm not going to provide the reported related party disclosure. I'm not going to go for IFRS 8 operating segments disclosure. I'm not going to recognize a loss allowance just because you are exercising your undue influence over me. Is it okay to compromise your objectivity? No, the reporting accountant will be straightforward and honest and say, you see, this is not possible. And even if this comes at a cost of losing your job, then even the reporting accountant cannot compromise. All right. So this is how you have read the question, and there are many points that are coming into your mind. So what's my opinion on how to approach question on ethics? I always suggest that you bifurcate all your answer into two parts. The accounting implications should be discussed first, and then you should be discussing ethical implications for the whole question in its entirety, right? So the accounting implications must always be discussed separately, because examiner has given you separate headings for each of the three issues he wants you to discuss. Therefore, you should be answering in the same pattern in order to get those 2 professional marks. Remember, those 2 professional marks are not just 2 marks. These are 2% of your entire examination. And sometimes these 2 marks can be very critical. For a person who was about to score 48, those 2 marks can land you at 50 and make sure that you pass this paper. For a person who was to score 98 marks, you can get additional 2 professional marks and you can, maybe score a world record in SBR, right? So please make sure not to make such a mistake, not to make a mistake by, just foregoing everything. So you do not forego these 2 marks. These are very critical marks for you. So let us just go towards an answer which I have already, constructed for you guys. And let us discuss the accounting implications first. As I said, always try to answer in a manner in which you discuss the accounting implications in one go for each of the headings which have been provided to you by the examiner. And by the end, you can discuss all the ethical implications in totality and then give the conclusion and remedy, right? So let's go through an already written answer. These notes will be provided to you, so don't worry about them. Yeah. So how do you approach this answer, right? So I'm just going to read it out, the lines. This is essentially the same which, whatever we have discussed up till now, but let's go through it, right? Related party transactions, you've got to put a heading just like your examiner did. And then how do you approach an answer? How do you approach an answer? There are 3 steps to approaching an answer. I always tell you. The first step is introduction. So you refer to the particular accounting standard, IAS or IFRS, which is the subject in this question. Then you go for application. Application means you connect the scenario within your answer, and then you try to provide the conclusion. The conclusion is always about what should be done as far as P&L or balance sheet is concerned, or your financial statements are concerned, right? Introduction, application, conclusion is the 3-step approach that we follow. As far as the introduction is concerned, the first part of the question was all about IAS 24. So how do you approach this? You start writing, according to IAS 24, the objective is to draw attention of the users of the financial statement towards the possibility that the financial statements may be affected due to transaction with related parties. Again, you need to remember what each and every accounting standard was saying. Yeah. So whenever I teach you something, I try to repeat things again and again. Why do I repeat things again and again? So that you eventually remember the accounting standard by your heart. Yeah. So IAS 24 requires you to provide full disclosure for the name and the nature of related party relationship and sufficient information of all transactions and outstanding balances between them. Furthermore, IFRS 8, the next accounting standard which was subject in this question was IFRS 8. So furthermore, IFRS 8, always try to use these kind of words, furthermore, moreover, however, yeah. These kind of joining words always help you to continue your answer. Yeah. So always try to use these type of words. Okay. So furthermore, IFRS 8 requires disclosures to be given for the results of operating segments which meet the criteria of the standard. The criteria for identifying operating segments are 10% of revenue, 10% of profit, or 10% of total assets. This is the definition for reportable segments. In the given scenario, now you are starting the application part, right? Remember, you are not supposed to give headings of introduction, application, or conclusion. I just want you to bifurcate your answering approach into 3 categories. Separate headings are not to be provided. Do not write introduction, application, or conclusion. Yeah? I'm just trying to make you understand that whenever you construct an answer, it should be done into 3 separate parts. So in this particular part, we are saying that in this given scenario, the finance director proposed not to disclose a related party relationship, as at first it was on arm's length basis. He was trying to make his opinion that since it is an arm's length basis transaction, you should not be disclosing it, as he believes that such a disclosure would provide competitive harm. However, you need to understand, IAS 24 has no exceptions. IAS 24 has no exceptions for arm's length transactions, and therefore full disclosure is mandatory, even if it can cause business harm. Furthermore, reportable segments are essential for faithful representation of financial transactions, and therefore omitting profit or loss figures will be against IAS and IFRS. Then you refer to IAS 1. Remember, I told you in my opening ethics lecture, it's always good to write this line. Yeah, it always supports your answer. So according to IAS 1, all IAS and IFRS shall be applied in full in order to be declared IFRS compliant financial statements. A departure shall only be allowed in extremely rare circumstances. For example, if there are legal constraints to the same. if reporting in accordance with IFRS would be so misleading for misrepresentation, would lead to misrepresentation. But either of the two cases are not applicable in this particular scenario. Neither it is a legal constraint that allows you not to report something. I mean, just because the industry practice is not to report such type of transactions is not a legal constraint, is not an extremely rare circumstance. And furthermore, by providing disclosures of IAS 24 or IFRS 8, definitely it would improve the faithful representationness rather than it would impair it. Yeah. As evident from above, competitive harm does not fall under exceptions. Then what was the second part of the question? According to IFRS 9, an entity shall recognize an allowance for receivable based on the expected credit loss approach. This expected credit loss approach can be designed into 3 stages. I think that these 3 stages, even if they were not written, it would have been fine. So you could have ignored this. In my answer, I have adopted for a more detailed approach, but this could have been skipped. It's fine to skip this part of information because in this particular case study, in this particular case scenario, not very much details were necessary because there were no ECLs being mentioned or anything like that. You could have ignored this stage 1, stage 2, stage 3 approach. In the above case, it is evident that R White has liquidity problems and therefore the loss allowance should be appropriately reported. It should be done. It is duty of accountants to report correct information and therefore creditworthiness of R White should not be a basis of concern for ABI. Yeah. And furthermore, you can add something like this. If such a loss allowance is not reported, then it would tend to you can say overstate the receivables position which is not fair representation of the financial affairs of the business. Make sense? Make sense? You need to write this stuff. All right. So understood. Now this is what you should have written. Now let's move on to the second part of the question. All right. Now in this part, your examiner is saying the scenario is, it says, additionally, when completing the consolidated financial statements, the director has suggested that there should be no positive fair value adjustments for a recently acquired subsidiary and has stated that the accountant's current position is dependent upon following these instructions. So technically, you are a reporting accountant who is in big trouble. Now, you have just identified that ABI has acquired a new company which is supposed to be your new subsidiary. And you are aware that according to IFRS 3, acquisitions are accounted for under acquisition method. And according to acquisition method, a company should be acquired and consolidated at fair value at the date of acquisition. All right. And when you acquire a subsidiary on a fair value basis for the purpose of consolidation, there will be some fair value adjustments. Now, your director wants you not to make positive fair value adjustments. But why? Because if upward fair value adjustments happen, then it will result in a goodwill reduction now. It will result in a goodwill reduction now. The accounting entry is, for example, if there is a fair value adjustment, upward fair value adjustment of building, then there will be building debit and goodwill credit. So clearly your goodwill will come down. And the other consequence that will arise is there will be some excess depreciation. There will be some excess depreciation years to follow. So there will be a loss of profit. So your director is saying that, okay, you must follow my authority, and I'm telling you that your current position is dependent upon following these instructions. Your director is, exercising his undue influence over you. So you are a reporting accountant, you should get afraid. You're going to say, no, 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 sir. No, sir, no. I'm afraid, sir. I will follow whatever you say. Is this what you are going to do? No. I mean, you are an accountant. You are an accountant. If you're an accountant, accountancy is everything for you. Everything else is secondary. Accountancy is mandatory for you. You should maintain your objectivity. You should not allow undue influence of others or your own personal interest or the risk of losing your job to override your professional judgments. You will say, oh, I don't care. I don't care. I will try to encouraging you. I will try to persuade you, finance director Sahib. I will try to persuade you to follow the right thing. But if you don't agree with me, I don't care. At least I am going to be on the right part. This is ethics. This is ethics. Okay. So it says the fair value of the subsidiary is $50 million above the carrying amount in the financial records. The reason given for not valuing the subsidiary's net assets is that your finance director, look at the mental level of your finance director. Your finance director is saying, my reason is that you should not be fair valuing the subsidiary's net assets because goodwill is an arbitrary calculation. He's saying goodwill is a judgmental thing. It's an arbitrary thing. It's not a mathematical thing. It's an arbitrary thing. And therefore, I can decide what goodwill should be reported. And according to me, you should not be doing any upward fair value adjustment. It's an arbitrary thing. Anybody can report goodwill according to their own opinion. Everybody has separate opinions. Everybody differ in their opinions in daily life. I mean, you might have an opinion that red color is very good. I might have an opinion that red color is not good. Yeah. You might have seen I always try to wear black and blue and white. Yeah. That's my opinion. So finance director says, you see, Sir Yasir also has his own opinion. So we should follow his opinion, na? We should follow his opinion. Huh? So everybody has their own opinion. Why are you saying that, proper fair value adjustment should be done? It's an arbitrary calculation. And he's saying, which is meaningless in the context of performance evaluation of an entity. You see, goodwill has nothing to do with performance evaluation. Salute to this finance director. Salute. You call him and you say, are you in your senses? Goodwill, first of all, is not an arbitrary calculation. Goodwill is the excess amount of consideration that you have over the fair value of net assets of S company. So it's not something arbitrary. And plus, goodwill calculation and the upcoming excess depreciation is relevant information being provided to your shareholders based on fair value basis. You're providing updated market related information to your investors. How can you even say that this is irrelevant information for your shareholders and this is nothing to do with performance evaluation of an entity? This is absolutely wrong perception. Absolutely wrong perception. Yeah. So what's the accounting implication of this and how are you going to answer? Let's look at a template answer for you guys. Subsidiary fair value adjustments. So according to IFRS 3, I always go for introduction first. So according to IFRS 3, business combinations shall be accounted for as under acquisition method. Under this method, the subsidiary is consolidated based on the fair value of net assets at the date of acquisition. Any consequence of fair value adjustment should be recognized in the post-acquisition period in CR and NCI. So post-acquisition consequences like excess depreciation should be accounted for under CR and NCI. In this case, now the application part comes. Whenever we are writing about application, we start with in this case. Whenever you are talking about like the first paragraph, we start our answer with according to. And whenever we are talking about, whenever we are applying the application step, where we are trying to refer to the case, I always try to start my answers with in this case. So in this case, the finance director wishes to avoid upward fair value adjustments amounting to $50 million because it will dilute goodwill on acquisition and will also create excess depreciation in the post-acquisition period. This is not acceptable as IFRS 3 requires acquisition on fair value basis. The accountant should persuade the director at least to recognize the following adjustments: asset debit, goodwill credit, CR, NCI debit, asset credit for any, this is for any, post acquisition excess depreciation, right? Make sense? Further, the accountant should inform the finance director that IFRS 3 has conclusive guidelines on how to determine goodwill at acquisition date, and therefore it is not an arbitrary calculation. The idea that goodwill is an arbitrary calculation is not true. It's a false perception of the finance director. Yeah. Now moving forward to the third paragraph. Examiner says goodwill impairment calculation. All right. Finally, when preparing the annual impairment test of goodwill arising on other subsidiaries, the director has suggested that the accountant remains flexible in the assumptions used in calculating future expected cash flows, so that he's being very blunt with you, so that no impairment of goodwill arises. And the accountant should use a discount rate which reflects risks for which future cash flows have already been adjusted. He has indicated that he will support a salary increase for the accountant if he follows his suggestions. Wow. You see, according to IS 36, impairment is said to arise when your carrying value exceeds your recoverable amount. Recoverable amount is always higher of two things: fair value less cost to sell and value in use. So value in use is basically present value of all future cash flows, and present value of all future expected cash flows are determined by discounting the future expected cash flows of, let's say, 5 years. And according to IS 36, you should be using a discount rate which is appropriately adjusted for the risks associated with the nature of the asset and the business nature, right? But you should not be taking such a discount factor which is, which has been diluted so that your future cash flows are higher. What I'm trying to say is, your finance director has a request. He knows that how value in use is calculated. So you take future cash flows of, let's say, year 1, year 2, year 3, year 4 and year 5, and then you discount them against a discount factor which is calculated on a discount rate. He wants you to take a lower discount rate. Yeah. He wants you to use a discount rate which reflects risk for which future cash flows have been adjusted. So he wants you to take a lower discount rate by adjusting for risk. So for example, if your normal discount rate is 10%, and if there are certain risks associated with the asset, he wants you to discount the discount rate. Let's say you take the probability of risk as 20% and take the discount rate as 8%. That doesn't make sense. I mean, you have already considered risks in your cash flows, and then your finance director wants you to double count that risk by taking the risk in discount rates as well. He wants you to reduce the discount factors so that you get a higher present value of cash flows. And if you get a higher present value of cash flows, most likely your recoverable amount would be higher as well. And if your recoverable amount would be higher as well, you will be avoiding any impairment loss. And he says he will support a salary increase for you. Wow. What should you be doing? Should you be accepting the salary increase offer and saying, oh my God, my life will be settled if I get this salary increase? No, my dear. No. You should not allow your personal interest to override your professional judgments. Whatever motivation your finance director is trying to offer you, you cannot lose your objectivity. You cannot compromise on your objectivity. That is not acceptable. Yeah. So you should be straightforward and honest in all your business and professional relationships, and you should make sure that you persuade the finance director not to do this thing. And if that thing does not happen, you know what's the conclusion and remedy steps. All right. So maybe why your finance director is asking you to be more lenient about impairment calculation, because he wants to avoid impairment. If he avoids impairment, like he wanted to avoid future excess depreciation, he will make sure that the profits are higher. He wants to inflate the profit so that it shows better performance of his own. Yeah, he clearly has his own personal goals, but you should not. You should be straightforward and honest in such scenarios. You should not allow this whole subjectivity and scenarios to override your judgments. This is wrong. Yeah. How to approach this answer? You refer to IS 36 first. So according to IS 36, remember, try to give this heading. Giving this heading is important. Why? Because you need those professional marks, right? So you need to clearly structure your answer. Those professional marks are required. So according to IS 36, an entity shall perform impairment testing whenever a hint arises. Furthermore, an annual impairment test is mandatory on purchased goodwill and intangible assets with indefinite useful life. IS 36 has also provided some specific guidelines on how impairment test should be conducted. Recoverable amount, remember, is the higher of fair value less cost to sell and value in use. When determining value in use, following points must always be taken into consideration. Remember, we studied this. Cash flow should represent management's best estimate. Cash flow forecast should not be more than 5 years unless a justification can be provided. Growth rate shall be constant or declining. Taxation and financing cash flow should be ignored. Again, you repeat the entire IS 36 so that you remember the entire IS 36 again. This is a recap class 2. If people say, okay, sir, you are not helping us revise the accounting standards, you are missing out on these type of lectures. If you're not taking these type of lectures, how will I make sure that you revise everything? I always allow you to revise all accounting standards, but during practice. These are not in the blue. We do practice and revise all accounting standards. Yeah. So till now, we have revised IS 24, IFRS 8, IFRS 9 and IS 36 as well. Yeah. And maybe some part of IFRS 3 too, when we talked about acquisition method. Yeah. So the finance director proposes to stay flexible. Use the terms from the question itself. Question term. Use critical words from the question itself. The finance director proposes to stay flexible while performing impairment tests, so much so that impairment is avoided, and this is unacceptable and is a threat to accountants' objectivity. You cannot allow your self-interest to override your professional judgment, right? The reporting accountant must ensure that all IS and IFRS are applied in full. And now, since we have read the whole question and we have counted the whole reporting implications, thereon, you can put up a separate heading for ethical considerations, and now you can talk about ethical considerations at once. The advice from finance director is motivated from self-interest because he wants the profits to be higher. He wants the company's position to be good as much as possible. He also wants his personal interests, like the market reputation of R White, his wife's company and his company. He wants that to be favorable as well. That's not something good. It is evident that the finance director has put undue influence over the reporting accountant by proposing that his job is at stake. Furthermore, he did not know about the calculation of goodwill. He said that it's an arbitrary calculation and that is against the requirement of professional behavior. Always remember to use the guidelines, the requirements of code of ethics and the threads thereon. Always make sure to use these words while you're writing about ethical implications, because these will give you professional marks, right? You cannot randomly use some words. You must be using the wordings of code of ethics and the threads that we have studied thereon. And due care and is therefore a clear violation of ACCA's code of ethics. Try to use such words as well. ACCA's code of ethics. Yeah. The accountant should be straightforward and honest in all his dealings and should therefore communicate the correct treatment to finance director. Otherwise, it is a direct threat to integrity. Now, concluding on this, how do you conclude this scenario? The accountant should persuade the director, and ask him to follow the appropriate accounting standard. Inform other directors if there is, if nothing happens. Remember, this part of the question, I have given only pointers, but you should not be answering in pointers. You should be discussing each and every point. This is to be done on your own. Yeah. You should be discussing this. Inform other directors. You should seek advice from ACCA or legal, or you should seek legal advice if necessary. Remember, if necessary, this word should always be provided. You cannot skip this word. Yeah. In an extreme circumstance, the reporting accountant should consider resigning from his duties and should not therefore not be a part of wrongdoings. In an extreme circumstance, if all above measures fail, still you should not be part of such wrong dealings. You should not be okay with not providing an IS 24 disclosure, not providing an IFRS 8 disclosure, not writing off a loss allowance, not providing for goodwill impairment. You should not become a party to this transaction and consider leaving your job. Yeah. But this is an extreme circumstance and a last resort. Remember, this is a last resort. Yeah. So this is how you complete a question with conclusion and remedy as well. I hope you understood this video very clearly. These type of questions and these type of answers I'll be providing you as part of your notes. Like always, you just need to make sure that you understand these things very well and start on preparing with such type of questions and answers for yourself as well. I hope you like this video. Please make sure that you provide me your feedback. This is very essential. Ethics question is very essential for your SBR preparation. So at any point in time, you should not decide to forego this topic. All right. These are very easy marks of your exam. I hope you get very good marks. Take care. Allah Hafiz.